3 more years. That phrase has cost American retirees more than any single bad investment decision in the last 50 years. Not because it's wrong about the money, it often isn't, but because it makes 4 separate miscalculations simultaneously, and every financial planner who nods along is billing you by the hour to not explain them. I'm going to walk you through all 4 today. And by the end, you are going to understand why work a little longer to be safe is itself a financial risk, with a price tag that compounds against you from the moment you make the decision. There's a Gallup survey from 2023 that asked Americans when they expect to retire. The average answer was 66. A separate Gallup survey asked retirees when they actually retired. The average answer was 61. That 5-year gap is not a data error. That is 5 years of plans meeting reality. And of the people who do reach their target date, a meaningful number spent the last 3 years doing a different version of their job, restructured, reclassified, reporting to someone 15 years younger, and paying hidden costs they were never told to track. I've spent a decade around accountants, tax lawyers, and financial documents that nobody reads voluntarily. I have several $100,000s of my own money invested. I'm not talking theory here. And what I keep seeing is not people who retired too early and ran out of money. It's people who worked 3 extra years as a buffer and came out the other side in approximately the same financial position, but measurably older, less healthy. And in 2 cases, I know personally, with a medical diagnosis that permanently changed what retirement actually meant to them. So here's what I'm going to do. I'm going to give you 4 specific mechanisms, 4 line items on the hidden bill that 3 more years generates. Each one gets worse than the last. And I'm going to run real math, not projections from a brochure. But first, I need to give you the mental model that's going to hold all of this together. Imagine you're in a taxi. You got in because you needed to get somewhere. The meter runs. At some point, the driver pulls up to your destination. But instead of getting out, you say, hold on, let me ride a little longer, make sure the address is right. The meter keeps running. Now here's the detail that matters. In this particular taxi, the fare structure changes the longer you ride. After a certain point, each additional mile costs more than the last one. Not because the driver changed the rates, because the rates were always structured this way. They just weren't posted on the window. The driver didn't mention it. Frankly, it's better for business if you keep riding. That taxi is your career. The destination you already passed is your retirement number, the point at which your portfolio can sustain your spending indefinitely. The extra miles are what we're talking about today. 4 separate charges on the meter that you are paying right now if you are past your number and still in the cab. I'll show you the first charge in a moment, but I want to plant something first because it's going to reframe the second charge in a way that most people find genuinely uncomfortable. The question is not whether working longer makes your portfolio bigger. It does, obviously. The question is whether the thing you are buying with those extra years is worth what you are actually paying for it and whether you are even measuring the price correctly. Hang on to that question. The first charge on the meter is sequence of returns risk. And the reason this one surprises people is that they think it's only a concern when you retire too early. It's not. It's a concern whenever you retire. But working 3 more years doesn't eliminate it. It changes the specific lottery ticket you're holding. Let me tell you about a software architect named Marcus. By 59, Marcus had $1.2 million invested. His number, the amount his financial planner said he needed, was $1 million. He had crossed it nearly 2 years prior. But his planner suggested they shoot for $1.5 million, just to be safe. Marcus worked 3 more years. He hit $1.5 million in early 2022. He retired in March of 2022, which for anyone who has looked at a chart of that year was approximately the worst time to retire into a balanced portfolio in 4 decades. The S&P 500 dropped roughly 19%. The bond market dropped simultaneously, something that hadn't happened in decades, making traditional balanced portfolios unusually vulnerable. Marcus watched his $1.5 million fall to roughly $1.1 million by October of that year. He ended up in nearly the same spot he would have been if he'd retired at $1.2 million 3 years earlier, except he was now 62 instead of 59. And the years he had planned to spend hiking Patagonia in 2-week sections, the years when his knees worked at full capacity, were spent in conference rooms and on commutes. This is sequence of returns risk and has a specific shape that financial planners tend to underexplain. When you are in the accumulation phase, putting money into a portfolio a bad market year is actually helpful in one respect. You are buying shares at cheaper prices and getting more of them. The mechanism of dollar cost averaging works in your favor. But the moment you switch from accumulating to withdrawing, when you need to sell shares to pay for living, the math inverts completely. A portfolio that takes a 30% hit in year one of retirement and simultaneously experiences a withdrawal of $50,000 is selling shares at the worst moment. Those shares are gone. They do not come back to compound. A portfolio that takes the same hit in year 15 of retirement is much more likely to survive because 15 years of compounding created a much larger base. The critical point: working 3 more years does not reduce your probability of retiring into a bad market. It shifts the window of when you encounter that market. Marcus thought he was building a buffer against a crash. He built a buffer that got deposited directly into the crash he was trying to avoid. The 3 extra years gave him more money in the account and 0 additional protection against the specific risk he was worried about. The research backs this up in sobering terms. A paper from the Journal of Financial Planning found that a $1 million portfolio with a 4% withdrawal rate succeeded in approximately 95% of 30-year historical simulations. A $1.2 million portfolio, the rough margin you'd add by working 3 more years on a $120,000 salary, succeeded in approximately 97%, 2 additional percentage points of survival probability. That is what 3 years of Marcus's life was worth in pure survivability math. 2 percentage points. Now you're thinking, fine, but 2% matters. And it does in the abstract, but here's the thing. That 2% can be achieved through portfolio construction choices that take about 45 minutes and cost nothing. A small cash buffer of 1 to 2 years of expenses held outside the market essentially eliminates sequence of returns risk in the critical first window. That's a portfolio design decision, not a time in the workforce decision. The problem your financial planner suggested solving with 3 years of your life has a weekend solution. You just weren't told about it. Now for the second charge on the meter. And this one is the one most people feel in their gut but never see priced correctly. Your body's depreciating asset. I know that sounds cold, but finance is about asset valuation, and your physical capacity, your ability to do the things you save for, depreciates at a measurable rate. A study from the Rand Corporation tracking retirement quality of life found that self-reported physical capability declined at roughly 3% per year, beginning around age 62. 3% per year compounded over 3 years is approximately 9 to 10% of total capacity. That's not nothing. That is a weekend. Every week for the rest of your life. Now let me run the actual math on what those 3 years bought your portfolio, because this is where the framing usually goes wrong. Say you earn $120,000 a year. After federal taxes, state taxes, and FICA in a reasonably high tax state, you're taking home around $80,000. You're living on $60,000. So your actual net new savings per year of additional work is around $20,000, not $60,000, not what your gross salary implies. $20,000 of real new capital per year of your 60s. Meanwhile, your existing portfolio, let's call it $1 million, growing at a 7% annual return, is generating $70,000 of growth in year 1 without you doing anything. Your portfolio is making more than 3 times your marginal labor contribution every year in your sleep. So the genuine marginal value of working 3 more years, the money you made that you could not have made by simply stopping and investing, is about $60,000 total over 3 years after taxes, after living expenses. Not the $360,000 your gross salary implies. 60,000 real marginal dollars in exchange for 3 years of your early 60s. That number hits differently when you think about what you'd pay for 3 early 60s years if you were 75. By the way, hit subscribe if you like this kind of breakdown. YouTube may never surface my videos to you again if you don't. And I've got a lot more where this came from. Here is something I need to address before we get to the Social Security mechanism, because it changes the stakes of this entire conversation. There's a number I encountered in researching for this video, and I went deep into the EBRI data, the Health and Retirement Study out of the University of Michigan, and a Boston College Center for Retirement Research paper from 2023 that I want you to hold in your head for the rest of this script. The number is 58%. That is the approximate share of workers who plan to work past 62 but are involuntarily pushed out of the workforce before reaching their target exit date. Layoffs, health events, corporate restructurings, caregiving responsibilities. The reasons are diverse. The financial impact is consistent. Involuntary early retirees end up with roughly 20% lower retirement income than voluntary retirees, even when controlling for initial wealth level. Not because they made worse investments, because the plan got disrupted before it could be executed. I want you to keep that number 58% in your head while I introduce someone. Her name is Linda. She was a hospital administrator, mid-50s, exceptionally good at her job, well compensated. She had a plan. Work until 64. Let her 401k run another 4 years. Claim Social Security at 70 and collect the maximum benefit. In 2019, her hospital system was acquired. In 2020, her administrative layer was eliminated during COVID restructuring. She was 61, her plan said 64. Linda didn't blow up. She wasn't reckless. She was a planner who got hit by something completely outside her plan. We're going to come back to Linda. Social Security is the third charge on the meter. And this one generates a specific kind of frustration when you run the numbers, because the advice that sounds right is actually concealing a conditional probability that almost nobody talks about. The logic for working longer in Social Security terms goes like this. If you claim at 62, you receive approximately 70% of your full retirement benefit, the amount you'd collect at your full retirement age of 67. Wait until 70 and you get 124%. Every year you delay between 67 and 70 earns you 8% more benefit, guaranteed, backed by the US government. There are very few investments on earth with that kind of risk-free return. So the conventional wisdom, work longer, delay claiming, collect more, is mathematically defensible. Here's what it hides. The break-even on Social Security delay the age at which the larger monthly check outperforms the cumulative sum you'd have collected by claiming early is somewhere between 78 and 82, depending on your specific benefit and the assumed discount rate. The Social Security Administration's own data puts median life expectancy for a 62-year-old American man at approximately 80. That is a coin flip on whether delayed claiming ever breaks even. Not a slam dunk, a coin flip. And then remember Linda. 58% of people who plan to execute the delay strategy don't get to execute it as planned. Linda's plan was delay until 70. Her reality was a forced exit at 61. When you're forced out at 61 with a portfolio sized for a 64-year-old's retirement, you face a very specific menu of bad options. You can claim Social Security early and take the permanent reduction. You can drain your taxable brokerage account to bridge to Medicare at 65. You can go back to work at a lower compensation level. Linda did some version of all three in rotation for 3 years. Her retirement income at 64, the age she originally planned to retire, was 18% lower than her original projection. Not because the market failed her, because the plan had no structural margin for an early exit. Here's the irony. That's almost too on the nose to be real. If Linda had retired voluntarily at 59, the year she first quietly crossed her number, she would have had 4 years of planned, tax-efficient drawdown structured around an early exit. She would have had a bridge strategy for healthcare before Medicare. She would have been positioned for the disruption instead of destroyed by it. She worked 3 more years for safety. The safety got eliminated in a merger she had no vote on. The taxi meter was running. The driver decided to stop the cab. Now, let me put all of this into a single realistic scenario, because I think seeing it as one person's numbers is more clarifying than 4 separate arguments. Take someone named James. He is 60 years old. He has $900,000 invested in a diversified index portfolio, roughly 80% equities, 20% bonds. His annual spending is $54,000. By the standard 4% rule, he needs $1.35 million to retire. He is not there. His financial planner says, 3 more years and we're golden. So James works. He earns $110,000, saves about $40,000 per year after taxes and spending, and his portfolio compounds at 7% annually. After 3 years, his portfolio sits at roughly $1.3 million between new contributions and market growth. He's at the number. He's 63. Now, the alternate James, he retires at 60 with $900,000. He draws $54,000 annually. Year 1, after a 7% return and $54,000 in withdrawals, his portfolio is approximately $909,000. Year 2, $972,000. Year 3, just over $1 million. By 63, without working a single additional day, alternate James has a portfolio within $300,000 of the working James. That $300,000 gap sounds significant until you model both portfolios forward 30 years. Both survive in the vast majority of historical market scenarios. Alternate James has a marginally tighter withdrawal rate, about 5.4% versus 4%, which introduces real risk. But that risk can be managed through a small cash buffer, a flexible spending adjustment in down market years, or any of about 6 different dynamic withdrawal structures, none of which require 3 years of additional work. The difference isn't ruin versus survival. The difference is what happened between age 60 and 63. Working James spent those years doing the job. Alternate James spent them doing whatever 60-year-old James actually wanted to do with his one functioning pair of knees and his peak leisure capacity years. And in the scenario I find most instructive, Working James's company announced restructuring in the final year of his 3-year plan. His role was reorganized 2 months before his target retirement date. He left with 6 months of severance instead of full vesting on his 401k match. That cost him $30,000 in unvested contributions, money that required 3 years of showing up every day to earn, and then disappeared in a reorganization memo. Working James lost 3 years and $30,000 to end up approximately where alternate James was. Now, I want to talk about the mechanism that causes intelligent, financially literate people to make this decision repeatedly, because the math I just showed you isn't hidden. Most of these numbers are publicly available. The EBRI surveys are online. The sequence of returns research is in peer-reviewed journals. People aren't staying in the cab because they don't have access to the information. They're staying because of something that operates below the level of information. This is the 4th charge on the meter, and it's the most expensive one, because it doesn't just cost you money. It costs you the ability to act on the information you already have. The behavioral finance literature has a name for what I'm describing. It's called 1 more year syndrome. It was first documented explicitly in the FIRE community, the Financial Independence Retire Early movement, but it describes a pattern that shows up everywhere across the wealth spectrum. You reach your number, you don't act. You add a new condition. Not consciously, not as a deliberate revision of the plan. You just find yourself saying, let me get to 1.1, then I'll feel good about it. And then you get to 1.1 and you say, 1.2 would be more comfortable. The goalposts move, but they move quietly without a meeting. The reason isn't greed, and it's not irrationality in the clinical sense. While you're earning, any financial risk, market crash, medical bill, unexpected expense, has a partial cushion. Your income absorbs part of the shock. The moment you stop working, the same risks feel enormous, even if your portfolio is mathematically prepared to absorb them. This is loss aversion in slow motion. The feeling of being exposed to risk is more influential than the calculation of actual risk. But here is the reversal that most people never articulate. You think the risk you're managing by working longer is financial. The actual risk you're creating by working longer is employment risk during the exact years when employment risk is highest. According to Urban Institute research on the health and retirement study data, workers over 50 face significantly higher rates of job displacement than their younger counterparts. When displaced, their subsequent wages are typically 20 to 30% below pre-displacement earnings. Your floor, if something goes wrong at 61, is not 0, but it is substantially lower than your current salary, and the probability of something going wrong is higher than your planning document assumed. You are not in a safe position while you are working. You have traded one visible risk for an invisible one, and you made that trade at the exact age when the invisible one is most dangerous. Here's how this plays out in the taxi metaphor. You're in the cab, you passed your stop. The meter is running the extended fare structure. And here's the part nobody mentions. There is a version of this cab where the driver decides to stop. Not you, the driver. The restructuring memo, the medical diagnosis, the industry contraction. The moment someone else stops the cab for you is the moment you discover you've been riding past your destination while paying premium rates, and the exit is no longer on your terms. Here's a practical counterexample that I find genuinely instructive. A tech manager in his mid-50s, someone I know through a shared accountant. So I've seen the actual financial picture set a simple rule. When the portfolio hits $900,000, he leaves within 90 days. His financial planner pushed back. Friends thought he was being reckless. He left at $920,000. He is 68 now. He's never touched his principal. His annual withdrawals have averaged $42,000. His portfolio sits at $1.4 million because compounding ran for 8 years while he was busy doing other things. His friends who kept riding, a couple got laid off in their early 60s and landed in the involuntary exit bucket. One had a health event that would have been devastating if it happened during an active career, but because he'd already left, turned into a disruptive but manageable detour. The manager made one decision early and then got out of the way. The taxi stopped when he said stop. By the way, I realize I should acknowledge what you might be thinking here. Okay, but he had $900,000 and a $42,000 spend. Most people don't have that. Fair. The specific numbers aren't the point. The point is the structure. He made a rule. He pre-committed to a departure. He ran the math on what his actual marginal income was versus his portfolio's compounding. He found they were not that different. He decided to let the portfolio be the engine and stop paying rent on a job to be the buffer. Now, Linda. Remember Linda? Linda didn't get to make that choice. She worked 3 years past her quiet number because the plan said 64. And there was no rule, no pre-commitment, no margin for disruption. When the disruption came, the plan had no structure to absorb it. At 68, 7 years later, Linda is stable, retired, and doing fine in the grand scheme of things. But she spends a lot of time thinking about the version of herself that retired at 59 when she first crossed the number quietly. The version that had 4 years of planned, flexible drawdown before the merger. The version that didn't have to scramble, that version existed. She didn't act on it. And the 3 more years she worked didn't protect her. They just made the scramble happen later. Let me leave you with 3 things that are specific to this decision. Not generic retirement tips, but the actual practical moves that address the mechanisms I just walked through. The first is to calculate your actual marginal income, not your gross salary. Take your annual salary, subtract taxes, federal, state, FICA. Subtract your current annual spending. What's left is your real net new savings per year of additional work. For most people in their late 50s with above median salaries, this number is between $20,000 and $50,000 per year. Now compare it to the annual growth your existing portfolio generates at 7%. In most cases, you will find that your portfolio is already doing most of the heavy lifting. The gap between working James and retired James at 63 is smaller than the gross salary implies by a factor of 3 to 5. The second is to run your involuntary exit scenario explicitly. Model the situation where you are forced out 12 to 18 months before your target date. What does your Social Security decision look like? What does your portfolio withdrawal rate look like? What is your healthcare bridge? If that scenario is survivable, and for most people who are within reasonable range of their number, it is then the primary function of your 3 more years plan is to protect you against a risk your number already handles. You are buying insurance you already own. The third is to make the rule before you need the rule. Not a target, a rule. A specific portfolio threshold and a specific departure date, pre-committed, written down, shared with one other person who will hold you to it. The 1 more year syndrome feeds on the absence of structure. It lives in the space between two conscious decisions. A rule is a wall. When I hit X, I leave by the end of that quarter is a wall. When I feel ready is not a wall. It is an open door to an indefinite commute. The taxi is still running. The meter's still going. Your stop was 2 or 3 miles back. The question is not whether you know this, you probably do. The question is whether you are going to make the rule that gets you out of the cab on your own terms, or whether you are going to keep riding until someone else makes that decision for you. Lazy investing built more fortune than crypto memes, and 3 more years built more regret than almost any market crash I've ever seen.